put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The Walking Dead. In the first 6 months of 2025, something broke. Not gradually, not predictably. It shattered all at once. Across America, Europe, and Asia, consumer-facing companies, household names that had survived recessions, wars, and pandemics, began filing for bankruptcy at a pace not seen since the 2008 financial crisis. But this wasn't a credit crisis. This wasn't a housing bubble. This was something far more deliberate. A calculated game of financial engineering that turned vibrant businesses into hollowed-out shells, their futures mortgaged for quarterly earnings reports and executive bonuses. The bodies are still being counted. The true architects of this corporate graveyard remain largely unnamed in mainstream coverage, but the evidence tells a darker story, one of systematic extraction, manufactured growth, and an industry-wide addiction to debt that was always going to end one way. This is the story of how an entire sector was designed to fail. The names read like an obituary of American retail. LL Flooring, once a staple for home improvement, filed for Chapter 11 in August 2024 and never emerged. Liquidation took them by early 2025. Big Lots, the discount retailer that had weathered 70 years of economic storms, surrendered to bankruptcy in September 2024, closing over 500 stores. Party City, which had filled birthdays and celebrations for decades, finally collapsed under $1.7 billion in debt, shuttering all 800 locations in January 2025. Joann Fabrics, Conn's Home Plus, Bob's Stores Express. Each name another gravestone in retail's largest cemetery plot in modern history. The financial press called it market correction. They pointed to e-commerce disruption, changing consumer habits, the lingering effects of pandemic shifts. All true, all incomplete, because buried in the bankruptcy filings, hidden in the debt restructuring documents, lay a more sinister pattern, one that revealed these companies hadn't simply failed to adapt. They'd been systematically engineered to fail. Consider the numbers. In the first quarter of 2025 alone, consumer-facing companies filed for bankruptcy protection at rates exceeding 40% higher than the same period in 2024. By mid-year, the retail and restaurant sectors had witnessed over 60 significant bankruptcy filings, a pace that financial analysts compared to the darkest days of the Great Recession. But 2008 was a liquidity crisis. Banks stopped lending, credit froze, the entire financial system seized. In 2025, credit was available. Interest rates, while elevated, were manageable. The consumer, though cautious, was still spending. So what killed these companies? The answer lies not in what they sold, but in how they were bought. Private equity had been circling retail like vultures over roadkill for 2 decades. The playbook was elegant in its brutality. Acquire a stable company with recognizable brand value and real estate holdings, load it with debt to finance the acquisition, extract maximum value through sale-leaseback transactions and dividend recapitalizations, then either flip it to another buyer or let it collapse under its own weight. The firms executing these strategies had names that rarely appeared in headlines: Sycamore Partners, Sun Capital, Alden Global Capital. They operated in the shadows of finance, their machinations hidden behind complex corporate structures and NDAs that kept their strategies classified. Take Sycamore Partners' relationship with Staples as a template. When they acquired the office supplies giant, they didn't invest in innovation or digital transformation. They loaded Staples with billions in debt, sold off valuable real estate assets, then charged the company millions in management fees annually. The business once profitable, once stable, was transformed into a financial engineering project where the company's survival became secondary to extracting value for private equity stakeholders. Party City's collapse illustrates the endgame of this model with particular clarity. When private equity took control, the company carried manageable debt and operated profitably. Within years, that debt had ballooned to $1.7 billion. The company was forced to close stores not because customers stopped buying party supplies, but because debt service consumed revenue that should have funded operations, inventory, and employee wages. In January 2025, when Party City finally shuttered, employees received severance notices with 0 days warning. Some learned their jobs had ended when they arrived to locked doors. The private equity owners walked away, largely unscathed, protected by the corporate structures they'd carefully constructed. This wasn't anomaly. This was strategy. But here's what the bankruptcy attorneys and financial restructuring experts whisper about in conference rooms. The 2025 retail apocalypse wasn't triggered by private equity deals from 2024 or even 2023. It was triggered by deals made in 2019, 2020, and 2021, an era of essentially free money when interest rates hovered near zero and leveraged buyouts reached historic peaks. During that period, private equity firms went on an unprecedented shopping spree, acquiring consumer companies with debt that carried one critical feature: delayed payment structures. These weren't traditional loans requiring immediate interest payments. They were sophisticated financial instruments, payment-in-kind notes, toggle bonds, covenant-light loans, specifically designed to push the pain into the future. The companies looked healthy on paper because they weren't servicing their debt yet. They were accumulating it, compounding it, letting it grow like a tumor in their balance sheets. The timer on these debt bombs was typically set for 5 to 7 years, which means deals struck in 2019 came due in 2024. Deals from 2020 and 2021 are coming due now, in 2025. And here's the cruel twist. When these bills finally arrived, they arrived in an environment of elevated interest rates, cautious consumer spending, and severely depleted cash reserves from pandemic-era disruptions. Party City's bankruptcy filing revealed the company was spending over $100 million annually just on interest payments, money that could have funded store renovations, e-commerce development, competitive wages. Big Lots disclosed similar figures, debt service that consumed profit margins and left nothing for reinvestment. These companies weren't failing because they couldn't attract customers. They were failing because they'd been structured to fail the moment interest rates normalized. The architects of these deals knew this. The financial models they ran before acquisitions included scenarios for exactly this outcome. They knew a significant percentage of their portfolio companies wouldn't survive the debt maturation cycle. They simply didn't care, because the game was never about building lasting businesses. It was about extracting maximum value in minimum time, then moving on to the next target. What makes this corporate graveyard particularly chilling is how completely legal it all was. Every leveraged buyout, every sale-leaseback transaction, every dividend recapitalization followed the letter of American corporate law. The regulatory framework, designed to protect stakeholders, employees, creditors, communities, proved utterly toothless against financial engineering at this scale. Consider the mechanics of a sale-leaseback, one of private equity's favorite extraction tools. A company owns its stores, distribution centers, headquarters, valuable real estate accumulated over decades. Private equity sells these assets to a real estate investment trust, pockets the cash, then forces the company to lease back its own former properties at market rates. The immediate cash influx looks good on quarterly reports, but the company has traded owned assets for perpetual lease obligations, fundamentally weakening its financial position. When bankruptcy eventually comes, landlords stand first in line for payment, while employees and vendors get pennies on the dollar. Toys R Us pioneered this model's darker implications when it collapsed in 2017, leaving 30,000 employees jobless while private equity firms fought over remaining assets. The bankruptcy court ultimately approved a settlement where workers received a fraction of their owed severance, while private equity investors recouped hundreds of millions. Congress held hearings. Reform was promised. Nothing changed. By 2025, the same players were running the same playbook with no additional oversight. Sun Capital's acquisition and subsequent destruction of Bon-Ton stores followed an identical pattern. Debt loading, asset stripping, eventual collapse. Alden Global Capital's systematic hollowing out of newspaper chains provided a roadmap that retail operators adopted wholesale. The business crime documentary practically wrote itself, yet enforcement agencies remained largely absent. The explanation for this regulatory vacuum reveals another layer of the darkness. Private equity firms are major political donors, their partners cycling through government positions in revolving door arrangements that ensure favorable treatment. The carried interest loophole, which allows private equity managers to pay lower tax rates than middle-class workers, survives every reform effort. Attempts to increase disclosure requirements die in committee. The very agencies tasked with protecting market integrity are often staffed by former private equity professionals who understand they'll likely return to the industry after their public service stint. This is regulatory capture in its purest form, the regulated controlling the regulators. But the 2025 retail apocalypse extends beyond companies under direct private equity control. A more insidious contagion has spread throughout the consumer sector, driven by a culture that normalized debt-fueled growth, regardless of ownership structure. Public companies, watching private equity generate spectacular returns through aggressive leverage, began adopting similar strategies. Share buybacks funded by debt became standard practice. Companies borrowing billions not to invest in R&D or employee development, but to artificially inflate stock prices by reducing share count. When times were good, this created wealth for executives whose compensation tied to stock performance. When the debt came due, the companies had no reserves, no cushion, no path forward, except bankruptcy. Bed Bath & Beyond's 2023 collapse previewed what would become a 2025 epidemic. The company had spent years buying back its own stock, while underinvesting in stores and digital infrastructure. When consumer habits shifted, they had no financial flexibility to adapt. The debt they'd accumulated for those buybacks became an anchor that dragged them under. By the time management attempted course correction, it was too late. The capital structure made survival impossible. This pattern replicated across the sector in 2025. Companies that might have survived modest revenue declines couldn't survive them while servicing massive debt loads accumulated during the low-rate era. The rise and fall became compressed. Businesses that had taken generations to build collapsed in months once the debt spiral began. But here's the revelation that should terrify anyone paying attention. For every company that filed for bankruptcy in 2025, there are dozens more that should have but didn't. They're called zombie companies, businesses that generate just enough revenue to service their debt, but not enough to invest in growth, innovation, or even basic maintenance. They're the walking dead of the corporate world, kept artificially alive through financial engineering and extended credit terms, their inevitable collapse merely postponed. The Bank for International Settlements estimates that approximately 20% of publicly traded companies in developed markets now qualify as zombies, companies that couldn't survive without continuously rolling over debt at artificially low rates. In the retail and consumer sectors, that percentage is significantly higher. These companies maintain storefronts and websites. They employ workers and serve customers. But their financial statements tell a darker truth. They're already dead. They just haven't stopped moving yet. What's particularly sinister about zombie companies is how they distort entire markets. They can't invest in improving products or services, so they compete solely on price, driving down margins for healthier competitors. They can't pay competitive wages, creating downward pressure on labor markets. They occupy retail space that could go to innovative new businesses, effectively blocking creative destruction. Capitalism's natural renewal mechanism. And they create false signals of market health. When analysts count open stores and active brands, zombies appear in the data alongside genuinely viable businesses. Politicians point to employment figures that include jobs at companies that are technically already dead. The entire economic landscape becomes the elaborate facade, masking the rot underneath. The 2025 bankruptcy wave represents the first zombies finally collapsing. But the horde remains vast. Industry analysts privately estimate that another 100 to 200 consumer-facing companies are one interest rate hike away from insolvency, one bad quarter from Chapter 11. They're held together by covenant waivers from creditors who know they'll recover more by keeping the company operating a bit longer, by debt restructuring that merely delays the inevitable, by accounting treatments that hide the true state of deterioration. The question isn't whether these zombies will fall. It's when and how many will collapse simultaneously. Behind every bankruptcy filing are thousands of people whose lives are upended with no warning and no safety net. When Party City closed all stores in January 2025, 16,500 employees lost their jobs simultaneously. Many were hourly workers living paycheck to paycheck. Some discovered the news through social media before receiving official notification. The promised severance packages evaporated in bankruptcy court as creditors fought over remaining assets. This scene has replayed hundreds of times across 2025. Big Lots' closure of over 500 stores displaced tens of thousands of workers, many in smaller markets where retail options are limited. Express's bankruptcy eliminated another 5,000 jobs. LL Flooring, Cons Home Plus, Bob's Stores, each collapse another wave of unemployment, another community losing an anchor business, another group of families facing financial uncertainty. The Entrepreneurship Secrets magazine articles rarely discuss this side of the story. They focus on billionaire wealth creation, on successful exits and impressive returns. But for every private equity partner who walks away with millions from a distressed retail deal, there are thousands of workers who lose not just jobs, but often health insurance, retirement contributions, and career trajectories. Store managers who'd spent 20 years working their way up suddenly find themselves unemployed in their 50s, their industry-specific experience worth little in a contracting sector. Distribution center workers lose steady income in communities where alternative employment barely exists. Vendors and suppliers who extended credit to these dying companies write off millions in unpaid invoices, sometimes triggering their own financial distress. And the communities themselves bear scars that persist long after the bankruptcy proceedings conclude. Empty storefronts create blight that drives down surrounding property values. Lost tax revenue forces cuts to public services. The social fabric weakens as gathering places disappear and economic opportunity contracts. This is the true cost of financial engineering, costs externalized onto workers, communities, and society, while profits are internalized by a small group of financial specialists. The wealth and power flows upward. The consequences flow down. Yet some consumer companies have navigated this treacherous landscape and emerged stronger. Their strategies reveal what separated survival from collapse, and the lessons are stark in their implications. Costco maintained a fortress balance sheet, avoiding the debt trap entirely. While competitors loaded up on leverage to fund expansion and buybacks, Costco grew organically, reinvested profits into operations, and maintained financial flexibility. When market conditions deteriorated, they had the resources to adapt, invest, and even acquire distressed assets at favorable prices. Dollar General and Dollar Tree thrived by serving consumers trading down from traditional retailers, but they also avoided the private equity debt trap that killed many competitors. Their focus on operational efficiency over financial engineering created sustainable business models that could weather economic storms. TJX Companies, operator of TJ Maxx, Marshalls, and Home Goods, demonstrated that even traditional retail models could succeed with proper capital allocation. They invested heavily in supply chain technology and store experience while maintaining conservative leverage ratios. When over-leveraged competitors collapsed, TJX expanded into vacated markets, acquiring market share at minimal cost. The pattern among survivors is consistent. Strong balance sheets, sustainable growth strategies, long-term thinking over quarterly earnings manipulation, and ownership structures aligned with business health rather than asset extraction. Everything the private equity model opposed. This raises uncomfortable questions about capital allocation in modern capitalism. If sustainable success requires exactly the opposite of what private equity practices, why does private equity control such vast swaths of the consumer economy? The answer lies in asymmetric incentive structures, where fund managers generate fees regardless of portfolio company outcomes, and in tax policies that favor financial engineering over operational excellence. The stock market secrets that matter aren't complex derivatives or algorithmic trading strategies. They're simpler and darker. Systems designed to extract wealth while externalizing risk, supported by regulatory frameworks that protect extractors over stakeholders. As 2025 progresses toward its second half, industry analysts tracking debt maturation schedules see another wave building. The deals struck in 2020 and 2021, the peak years of pandemic-era cheap money, are now coming due, and the numbers are staggering. Over $200 billion in leveraged loans to consumer companies require refinancing between mid-2025 and early 2027. Much of this debt carries interest rates tied to now elevated benchmark rates, meaning refinancing will dramatically increase debt service costs, even if new terms can be secured. And for zombies companies already operating at break-even, even modest increases in interest expense will push them into insolvency. The restaurant sector faces particular vulnerability. Chains that expanded aggressively during the pandemic through debt-financed growth now confront elevated labor costs, increased food prices, and consumers pulling back on discretionary dining. Multiple casual dining chains have already filed for bankruptcy in 2025, and restructuring advisors report being contacted by dozens more exploring their options. Apparel retail faces a similar reckoning. The shift to online shopping accelerated during the pandemic hasn't reversed, leaving brick-and-mortar retailers with excess capacity, long-term lease obligations, and debt structures built for pre-pandemic revenue levels. Express's collapse previewed what awaits many competitors: business models rendered obsolete, balance sheets offering no path forward. Even sectors once considered resilient show cracks. Home improvement retailers, beneficiaries of pandemic-era housing booms, now face housing market slowdowns with elevated debt loads accumulated during expansion phases. The furniture sector, similarly pumped up by housing tailwinds, confronts the hangover of overexpansion and oversupply. Financial restructuring firms are hiring aggressively, anticipating a multi-year bankruptcy boom. These specialists, the undertakers of the corporate world, see the debt maturation schedules and understand what's coming. They're positioning to profit from the collapse, because someone always profits from collapse. But zoom out from individual company failures and a more troubling pattern emerges. The 2025 retail apocalypse isn't just about poor management or changing consumer preferences. It's about a financial system that actively rewards the destruction of productive businesses. Consider the incentive structure. A private equity firm acquires a retail chain for $1 billion, using $200 million of its own money and $800 million in debt loaded onto the company's balance sheet. They immediately execute a sale-leaseback of real estate, extracting $300 million. They pay themselves a $50 million transaction fee. They take a $100 million dividend recapitalization. Within the first year, they've recovered their entire $200 million investment and pocketed an additional $250 million, a 225% return, before the company sells a single additional item. Now, the company carries $1.2 billion in debt, the original $800 million plus the $100 million dividend recap, plus accumulated interest. It no longer owns its stores, it leases them at market rates. Management fees to the private equity firm drain millions annually. The business needs to generate extraordinary returns just to survive, let alone thrive. If the company succeeds against these odds, the private equity firm sells it at a profit or takes it public, generating another windfall. If it fails, they've already made multiples of their investment back. The downside is borne entirely by workers, vendors, creditors, and communities. The upside is captured almost entirely by the private equity firm. This isn't capitalism in the traditional sense, risk and reward aligned, innovation rewarded, failure punished. This is a fundamentally extractive system where financial engineering has replaced productive investment, where short-term wealth transfer supersedes long-term value creation. And it's perfectly legal. Every step follows corporate law. Every transaction gets approved by boards of directors. Every bankruptcy proceeds through established legal frameworks. The system isn't broken. It's working exactly as designed, just not for the benefit of most stakeholders. The lessons from 2025's retail apocalypse extend far beyond the consumer sector. The same debt-fueled extraction model operates across healthcare, media, industrial manufacturing, and technology. Private equity now controls an estimated $4.5 trillion in assets globally, with retail representing just one theater in a much larger campaign. Healthcare has witnessed particularly alarming developments. Private equity-owned hospital chains load facilities with debt, cut staffing to dangerous levels, then extract value through management fees and related party transactions. When hospitals fail, communities lose critical care access, but private equity investors have already recovered multiples of their investment. The business crime here directly impacts human health, yet regulatory intervention remains minimal. Nursing homes under private equity ownership show higher mortality rates and worse care outcomes. Multiple studies have documented. The debt loads make adequate staffing impossible, maintenance gets deferred, quality deteriorates. But the corporate structures that shield private equity from liability remain intact. The extraction continues. In manufacturing, the pattern repeats with strategic implications. Companies that once formed the industrial base of economies get acquired, loaded with debt, stripped of assets, then closed when debt service becomes unsustainable. The equipment gets sold overseas. The expertise disperses. Entire supply chains collapse. What was once a deliberate national industrial policy gets dismantled by financial engineering, with no regard for strategic consequences. The retail apocalypse serves as a warning. What happened to Party City and Big Lots and Express is a template being applied across the economy. The money and greed driving these transactions operates with increasingly sophisticated tools, creating distance between decision-makers and consequences that allows them to avoid accountability. And here's what keeps financial regulators awake at night, though they rarely speak it publicly. The zombie companies propped up by extended credit and accounting gimmicks create systemic risk that could trigger broader economic crisis. When healthy companies compete against zombies that can undercut prices because they're not properly servicing debt, it drags down returns across entire sectors. This reduces the incentive for genuine investment and innovation, creating a doom loop where the entire industry slowly zombifies. Eventually, something breaks. A credit shock, an economic downturn, a shift in consumer behavior, and the simultaneous collapse of hundreds of zombie companies triggers cascading failures through interconnected systems. The 2025 retail bankruptcies could be just the beginning of a much larger unraveling. The debt accumulated during the zero-rate era extends far beyond consumer companies. Commercial real estate, dependent on those retail tenants, faces its own reckoning. Regional banks heavily exposed to commercial real estate loans confront mounting losses. The interconnections create vulnerability that traditional stress tests struggle to capture because they focus on individual institution soundness rather than system-wide fragility. This is the financial mystery that haunts sophisticated analysts. How much of the apparent economic stability is facade, zombie companies, and zombie malls, and zombie business models all propped up by accounting treatments and credit extensions that merely delay inevitable collapse? When does the delay end? What triggers the next wave? And how many waves remain before the system itself comes into question? In January 2026, financial historians will look back at 2025 as the year the debt-fueled retail model finally collapsed under its own weight. They'll document the bankruptcies, count the job losses, analyze the failed business models. The business scandal documentary will be produced, the lessons will be articulated, the pattern will be recognized. But here's the secret that will likely stay buried. Nothing fundamental will change. The private equity firms behind these collapses will raise new funds, with investors eager to deploy capital into similar strategies. The regulatory reforms discussed in congressional hearings will die in committee, opposed by lobbying campaigns, funded by the very firms being investigated. The tax loopholes that make these extractions profitable will persist, protected by political donations that ensure favorable treatment. The legal structures that shield private equity from accountability will remain intact, refined, and strengthened by expensive attorneys. New targets will be identified, perhaps in healthcare, perhaps in technology, perhaps in sectors not yet identified as vulnerable. The same playbook will be applied. Leverage the acquisition, extract maximum value, externalize the consequences. Different companies, different industries, identical pattern, because the system that enables this extraction isn't incidental. It's structural, protected, and immensely profitable for those who've mastered its dark machinery. The 2025 retail apocalypse wasn't a failure of capitalism. It was capitalism working exactly as designed by those who write the rules. The real business thriller isn't about companies failing. It's about a system that rewards their destruction, that generates billions by dismantling decades of built value, that externalizes human costs while internalizing financial gains. And the most chilling part, it's all perfectly legal, all documented in public filings, all operating in plain sight while remaining effectively invisible to most people whose lives it impacts. The file was never supposed to see daylight, but it was never really hidden. We just weren't looking in the right places, or perhaps we were looking, but the system had already taught us not to see. Subscribe and listen to our next story below.